It looked like a conflict, but it wasn't. That's why a lot of people miss the point. It looked like fear, but it wasn't. The light wasn't even a sign that something was wrong. After one of the biggest rallies in years, one of the most experienced resource investors in the world cut most of his physical silver holdings right away. Just that time alone led to panic, guesswork, and a lot of wrong ideas. They thought there was a secret signal. They thought someone inside knew. They thought of a top. But the truth is much less exciting. It's more important, though, because it shows a flaw in the way most buyers think when the market rewards them. It's not really important whether silver is finished or not. The question is whether or not people know why they got it in the first place. Investors often change the past in their minds when prices rise quickly. They tell themselves that the job was always meant to be forever. They mix up outcome and purpose. In bull markets, gains are lost because of this misunderstanding. From the start, real silver had a very specific job to do. It wasn't a faith, that was not a name. It was an advantage for a short time. It was an incredibly hated guess that was bought when people were angry and expecting something different to happen. Silver was fired for many years. People made fun of it as dead money. It was seen as risky, manipulable, unimportant, and not worth investing in. Widespread dislike wasn't a red flag. It was the plan. The bar is low when an asset is disliked by everyone. Even the smallest change, in fact, can lead to a huge price increase. That's exactly what took place. Silver did not slowly get better. It broke, and it went too far when it snapped. At this point, math starts to matter more than feelings. If the price of an object from $20 goes up to $70 or more, it has not become safer. More money has been spent on it. That doesn't mean it can't go up even more. It means that the safety cushion has shrunk. There is no longer the imbalance that made the first chance possible. In the same way, this difference is what sets disciplined buyers apart from emotional ones. People who put money into a story because they believe in it still hold on. Disciplined buyers only hold until the numbers say it's a good idea. They change even if the story is still interesting when the math changes. The investor made this very clear. The goal of his physical silver position was reached faster and more aggressively than planned. The deal went through. The goal was surpassed. It was time for silver to leave the stock because it had done its job. After that, it would no longer be a guess that they would keep their post size the same. It would happen when you focus. And focusing on something without a new goal is not commitment. It is being exposed. That's the reason why most of the position was sold. Most of it, not all of it. Then came the part that made people the most nervous. The capital did not leave the room for resources. It turned around. The money went to places with more possibility for change, like some silver stocks and resource-based industries like energy. In this case, metals were not turned down. It was an understanding that at different points in a cycle, different vehicles behave in different ways. Metals that are physical often lead early. When people's feelings change, they reprick first. Later on, stocks tend to offer more leverage, as long as the owner knows how to handle the extra risks. That assumption is important. This isn't a general set of instructions. He can switch roles because he has studied resource equity for decades. He knows about financial structures, operational facts, political risk, management behavior, and jurisdictions. A lot of people don't. Losses happen when people copy actions without knowing how they fit into frameworks. The right thing to learn is not to sell just because someone else did it. Know why you bought something and what success looks like before it happens. That's the right lesson. If you don't know that, higher prices turn into a trap instead of a reward. The tool he uses to make sure that clarity is maintained is surprisingly easy to use. Every position starts with a one-page buy memo that explains why the asset was bought, what conditions support the thesis, what risks could disprove it, what price movement would mean success, how long is fair, and what specific events would cause a sale. That letter is read over and over again, not emotionally, but in a mechanical way. It sorts news through it. It is used to measure how prices move. If you don't have that structure, the market takes over, and the voice of the market is meant to make you feel the most sorrow. When prices go up, it tells you that you're smart and shouldn't sell. If prices go down, it means you were wrong and need to get out of the market right away. If you listen to that voice, you will have bad time. This is why it's risky to buy during bull markets. People are rewarded before they are tested. Before punishment is needed, there is validation. A lot of people think that feeling right means they are right. They don't hold because the trade still works, but because they like it now. He also said something that helps explain why a lot of people miss the best parts of big moves. Chances don't stay hidden for long. For years, it was clear why the prices of valuable metals were going up. Growing debt, ongoing deficits, dilution of the currency, geopolitical tensions, and supply limits. Nothing about this was a secret. What was missing was freedom to feel. People don't follow the facts. They do what they feel. And how people feel is based on recent price movement. A flat metal didn't make people feel anything. When metals went through a rise, everyone got it. The thing didn't change. It was the feeling. Later, especially after an explosive move, that mental lag leads to bad behavior. A lot of the time, markets go from fast repricing to slower digestion stages. The bull market doesn't stop, but it looks different now. When investors think that every month will be the big month, they get disappointed. When you're angry, you make bad choices. So far, the lesson hasn't been about calling heads. It's about knowing your jobs, your goals, and how to adapt. It's hard to buy something when you hate it. It's harder to sell something that you love. A lot of people can handle being scared. Not many people can handle walking away from approval. This is the reason why selling winners is the hardest part of investment, and this choice made a lot of people watching from the outside confused. This problem with selling things that work is something that most buyers only learn about after it's too late. It's uncomfortable to hold on to uncertainty, but it's rewarding to hold on to confirmation. When the price finally moves in your favor, especially after years of doubt, the feeling of satisfaction can be just as great as the money. That prize is risky because markets don't punish bad ideas as harshly as they punish strong emotional bonds. When a person's reputation is linked to an asset, objectivity is lost. The backer said that they learned this lesson the hard way, early on. During a previous bull cycle, he rode winning positions higher, didn't pay attention to signs that things were changing, and felt invincible. When the cycle finally turned, the damage didn't just wipe out gains, it went even further. What was a lot of money at the peak lost a lot of value when the market crashed. That experience left behind rules that will never go away. The rules in question are not theoretical models. They are ways of surviving that were formed after real loses. This past gives us an idea of how he feels about inflation and stable currencies. A lot of people find it hard to understand how official inflation numbers fit with what they see in their daily lives. Inflation often looks doable on paper. In truth, it feels like purchasing power is always going down. His concept is easy to understand and useful. The government doesn't keep track of inflation. It's what you can't buy with your money anymore. He asked everyone to do a simple comparison. Compare the costs you paid for together a few years ago to the costs they cost now. The prices of food, energy, healthcare, insurance, housing, taxes, transportation, and loans. After that, ask if the rise seems small. The answer is clear for most homes. This difference between what the government says and what people actually do is why hard assets keep going up in value over long periods of time. Gold, in particular, has generally been a more accurate indicator of currency decline than official stories. There is no such thing as a straight line in the market. Change is a part of the process. In long bull markets, it is normal for there to be corrections, stops, and shakeouts. Because the road isn't level, discipline is very important. When investors get trend and direction mixed up, they often lose money when the pace slows down. Public involvement was another question that came up a lot. Are regular people finally putting money into rare metals in a way that makes sense? His view had many sides. Even though more people are joining, it hasn't hit the extreme levels that are typical of late-stage mania. Capital movements and attention show early signs. In the past, when more people start to invest, silver often starts to do better than gold. Full speculative excess, on the other hand, looks different. It's busy, loud, happy, and doesn't care about risk. Even though people are more excited, they are still not at that level. This makes for a strange situation where public stories sound extreme, but real positions stay cautious. Discussions are dominated by big goals, but many investors are still not well known behind the scenes. That gap can be a chance, but you need to be patient and disciplined because stories can change more quickly than facts. A part of the conversation that came as a surprise was about banking infrastructure. Instead of trying to make something completely new, he talked about attempts to build systems that make it easier to switch between currencies and assets. The plan was to buy a small institution that already existed and had a simple structure, then slowly add to its powers. Stability, clarity, and purpose were given the most attention. Before going live to more people, the systems were tested privately using personal capital. It was more important to be reliable than fast. The point of this story is not to promote something. It depends on the situation. It shows that experienced investors think the current system may be under a lot of pressure if they spend time and money building structures around hard assets and diversification. It's not made for short-term trades, but for long-term changes. That point of view supports the main idea that planning is more important than prediction. Going back to silver, the story that most people read was wrong because it left out important information. He gave away most of his real silver. That really does mean that. His main goal was accomplished. That doesn't mean silver won't be used again. It doesn't mean that prices can't go up. This means that his money could be used more wisely somewhere else at this point. It's not abandoning to sell a winner. Yes, it is efficiency. A lot of people naturally want to know if they should do the same thing. That reaction shows what the real trouble is. Personal standards can't be replaced by decisions made by other people. There is a basic question that every owner needs to answer. How does metal fit into your life? Is it money saved? Is it a policy? Is it just guesswork? Is it a hedge? Or is it comfort for the soul? How people act depends on the answer. For him, gold is for savings and silver is for betting. Because of this difference, gold was kept and silver was cut down. If you buy silver to save for the future, you will handle it differently than if you buy it to trade. Neither method is wrong in and of itself. They are confused with each other. Most people stay stuck because they are afraid of regret. The fear of selling and seeing prices keep going up. Fear keeps investors in bad situations long after it would be smart to move out of them. To answer this, he made a distinction between two kinds of mistakes, two kinds of sin, those that we do and those that we don't. It's commission to lose money. Omission means missing out on possible gains. They are not the same. You will have made money if you buy at a huge deal and then sell after a huge price increase. If the price goes up again later, it won't take away your earnings. It makes you think about guilt. Markets take advantage of this confusion by making it feel safer for prices to go up just as risks go up. So, exit factors that have already been set are important. Before your feelings get in the way, you need to decide what success looks like. The conversation then turned back to mining stocks, where this cycle was acting in a strange way. Usually, metals come first, then big suppliers, and finally speculative juniors. Smaller, riskier companies moved quickly and early this time, which changed prices and lowered future profits. As a result, he cut back on the riskiest options, knowing that by giving up some upside, the downside risk would be much lower. That trade-off was planned. Professionals give up possible gains to keep their cash safe. The money wasn't taken out of the area. They were moved around to better companies and real cash. The theme stayed the same. The organization got better. It became less fragile. That difference is important. Giving up on a chance is not the same as giving up on a risk. The main idea stays the same. Before you can make money, you have to take money. Unrealized gains are tails. Resources are gained gains. Since there are no rules to change one into the other, most investors give back their gains to the market in the end. All of this comes down to one question that most buyers don't want to ask when prices are going up. What does it look like to have enough? If you don't have a reason, success is unstable. Gains feel like they will last until they don't. And not having a clear endpoint turns a strong situation into a weakness. This is why bull markets often end with the most damage happening after the most money was made. People don't lose just because they were wrong. They lose because they never chose when being right was enough. It's important to know the difference between selling based on fear and selling based on plans. Selling based on fear is a reaction. It happens when things go wrong, when the news is bad, when volatility rises, and when trust is lost. It comes from regret and keeps that regret in check most of the time. Plan-based selling is ahead of the game. It happens when people are feeling confident, when stories are positive, and when they don't feel like they need to sell anything. That pain is not a sign that something is wrong. That's proof that discipline is being used. He talked about a useful way to escape having to call exact tops, which is impossible. Setting price ranges ahead of time is needed. The first zone is getting rid of extra. This is just a small cut, not an exit. A small amount is sold just to change the amount of exposure and ease mental stress. The goal is not accuracy, but control. The second zone is where the goals are finished. At this point, the main idea has been proven true, and the planned action has taken place. Because that's what was agreed upon at the start, this is where real earnings are made. Menopause is the third zone. A mania is not just a high price. It is defined by being sure. There is no risk. People love using leverage. All of a sudden, everyone is an expert. When that situation comes up, buying doesn't take any bravery. It sells things. With zones, you don't have to guess what will happen in the future. It takes the place of guessing with truth. He also changed the way people should think about charts. Price movement doesn't tell you anything. It leaves you open. Even if worth goes up, fear goes up when prices go down. Even if risk grows, people are more confident when prices go up. Instead of giving you direction, charts are more like mirrors that show your feelings. Investors need to train their nervous systems, not their views, if they want to buy things that people hate. He suggested a workout that sounds easy, but works well. If the value of an asset is going down and people don't like it, you should think about what would have to happen for the drop to be an overreaction and not lasting damage. Then check to see if those conditions are true. If they do, it might be smart to be careful. Patience is the right thing to do if they don't. This is the line between being a dedicated contrarian and gambling without thinking. We'll talk about mining stocks again because leverage works both ways. When conditions are right, miners can do better than metals because their profits grow faster than their costs. But they also have risks that metals don't have. Even when commodity prices are high, value can be lost due to operational problems, government interference, rising costs, dilution, and management mistakes. That's why the rules for mining stocks are different. They are not long-term assets. They are opportunities with conditions. It's very important to have liquidity. When markets are going up, liquid names can go up and make it look like things are safe. When prices go down, those positions can fall down without any buyers. The price given isn't always a reality. This is why it's not a sign of weakness to lower your risk after big moves. That's how professionals act. During cycles, experienced investors stay involved and lower the risk of the tail. Energy exposure was talked about for the same systemic reasons. The investment and depletion processes in oil and gas are what move them, not how people feel. Supply stress happens when there are periods of not investing enough. It's the same buy, hate, sell, favor concept that guided the silver decision. When stories change, capital quickly returns, moving into areas where pessimism is still priced in, while optimism fills up other areas. This leads to a more general psychic alert. When investors let an object define who they are, they can't make good decisions. Identity doesn't want to be sold. Identity fights back twice as hard. Identity turns markets into battles of egos. Identity doesn't pay off in markets. They praise being able to change. You don't have to turn into silver to believe in it. A simple filter helps figure out if spinning is the right thing to do. If you can't clearly explain why an investment will be worth more in 2 years, you should be very careful with it. If you can't sum up the main risk in one line, you should be careful. If you can't say what would make you sell, you need to be very careful. Things that are physical are forgiving. Bad choices about equity are not. Another theme that was missed was too much information. Commentary, recaps, and analyses are constantly being sent to people who trade in modern markets. A lot of it is used again. Some of it gets stronger. It doesn't change things very much. Getting more information is not the answer. It's making better screens. He came up with 3 questions. Does this new information change what I'm saying? Does it change how I see time? Does it change the size of my position? It is noise if you answer no to all 3. This makes a simple template that can be used by anyone. Why I own it, what my goal is, how long I have to reach it, what my biggest risk is, what makes me sell, and if you want, what would make me add. This arrangement works for all types of assets. It clears things up before emotions show up. He made it clear that taking gains is not betrayal, it's maintenance. You can still sell even if you think the market is going up. You can be sure that prices will go up and still cut your risk. Markets do not reward loyalty. Follow the rules. One last useful point ties everything together. Know how exposed you are. Figure out how much of your net worth goes to each area. If you don't know that, there is no portfolio, only accumulation. Building up without foundation is weak. The talk about banking systems comes up again here to set the scene. A lot of people try to get freedom by investing in hard assets, but they leave all of their cash in systems that are under more and more stress. When experienced investors come up with options that combine the ability to change currencies and the security of assets, it shows that they are planning for the long term instead of speculating in the short term. It's important to know why these tools are being built, even if you never use them. Do not try to guess what will happen next with silver. It has to do with duty. A wise investor bought silver when it was worthless. He held on through doubt. He saw the price changes happen. He reached his goal, and then he made changes. He didn't let headlines make choices for him. He didn't mix up faith and math. He stuck to a plan that had been formed over time. What you should remember is not that you should sell silver. It tells you to stop giving choices to other people. Plan what you're buying. Set goals for success before it happens. When goals are met, lower exposure. Turn based on skill, not copying. Use rules instead of hope to protect what you've gained. The markets always try to get buyers to give up their rules just when those rules are needed the most. People who make it through aren't the biggest or bravest. They're the most ready.